Welcome back to Simply FRM. Today, we start with put-call parity. This is a no-arbitrage equilibrium relationship that links European call and put prices to the underlying assets price and the strike price. The fundamental formula is C minus P equals S minus PV of X. In continuous time, we calculate the present value of the strike price as PV of X equals X times e to the power of minus RT. If this equation doesn't balance, a trader could make a risk-free profit. Because this is a no arbitrage rule, it must hold true regardless of whether the asset price distribution is log normal or not. This brings us to a critical implication for implied volatility. If we rearrange the parity and look at the difference between market prices and BSM model prices, we find that any deviation in the call price must be matched by the exact same deviation in the put price. Because of this, the implied volatility for a call and a put must be identical for the same strike price and expiration. If they weren't equal, an arbitrage opportunity would exist. When we plot this volatility against different strike prices, we see patterns. A volatility smile is a U-shaped curve often seen in currency markets. It happens because the market expects extreme price movements, or fat tails, more than the BSM model suggests. In equity markets, however, we usually see a volatility skew. This is an inverse relationship where lower strike prices have higher implied volatility. This downward slope exists because investors are generally more afraid of a market crash and will pay a premium for low strike puts to protect their portfolios. But volatility doesn't just change with the strike price, it also changes with time to expiration. This is known as the volatility term structure. Volatility often exhibits a mean reverting characteristic. When short-dated volatilities are historically low, volatility tends to be an increasing function of maturity. Conversely, when short-dated volatilities are high, volatility tends to be an inverse function of maturity, meaning it decreases as the time to expiration increases. When we combine the volatility smile with the volatility term structure, we get the volatility surface. This is a 3D map that allows traders to price options with any combination of strike price and maturity. A trader's primary objective is to maintain a pricing mechanism consistent with the market. By using the volatility surface, they can confirm or disprove a model's accuracy and ensure their prices stay consistent, even if they switch from the BSM model to an alternative one.